IAS 8 Accounting Policies, Changes in Accounting Estimates and Errors, Video 3. Errors can arise from recognition, measurement, presentation, or disclosure. It is really important to understand that if an error occurs during the preparation of the financial statements of a current year, while you are preparing those financial statements, you realized you did something wrong. You would simply fix that error and continue with preparing the financial statements. This is not the type of error that IAS 8 deals with. IAS 8 deals with something called prior period errors. In other words, an error that has occurred in financial statements that have already been issued. Users have already used those financial statements. It's a prior period. It is not the period you are busy with at the moment. Sometimes material errors that happened in a prior period, in prior financial statements that have already been issued, is only detected in subsequent periods. Now, those errors could happen in the comparative year or even further back in one of the prior years, even before your comparative period. What does IAS 8 say? What do you do if you detect such a prior period error? You need to correct that error retrospectively, meaning you need to go backwards and fix the error as if it did not happen. So in the year where you are busy with financial statements, where you detect the prior period error, in these financial statements you are busy with, you need to go backwards and fix the prior period error. You need to restate your comparative amounts if the error occurred in the comparative year, or you need to restate the opening balances of your comparative amount if the error occurred in even an earlier period. You need to go retrospectively unless it is impracticable to determine the period-specific effect or the cumulative effect. IAS 8 has specific guidelines on how to account for a prior period error if it is impracticable to determine the period-specific effect. IAS 8 also has guidance on how to account for a prior period error if it is impracticable to determine the cumulative effect. Bottom line, go back and fix the error as far back as possible. For FRK 201, there is a separate handout about impracticable situations. Please work through those examples in the handout. So if we look on the timeline, in the current year, while you are busy with the current year financial statements, a prior period error is detected. If that prior period error happened in the comparative amounts, you would restate this specific period. You would change your comparative amounts. You would correct them and you would do certain disclosure. If the error happened in a period before your comparative year, you would need to restate the opening balance of all assets and liabilities and equity for the earliest prior period presented and do the disclosure. IAS 8 explains the disclosure needed for a prior period error. It is done in a separate note titled Prior Period Error. The first thing that needs to be disclosed is the nature of the error. What was done incorrectly? Then you need to disclose the effect of that error, the effect of fixing the error, the amount. And you need to disclose this for each prior period presented. It is really important to see that a prior period error, you do not disclose the effect thereof in the current year because it is not a current year error. Any error that occurs in the current year while you are busy with the current year, you would just fix. You don't need to tell your users, oh, I made a mistake here, but I fixed it. That's not the type of error that IAS 8 deals with. This is about errors that occurred in financial statements that have already been published. So it's a prior period error. So you need to disclose the effect of the correction for each prior period presented, not the effect in the current period. You need to disclose the effect for the prior periods presented on each financial statement's line item. Again, look at the wording. It is line items. What line items increased or decreased because you corrected the error? Something like depreciation is not a line item. Which line item includes the depreciation that might have been incorrect? You also need to disclose the effect of correcting the prior period error on basic and diluted earnings per share. Earnings per share is a topic we will do later this year. If retrospective correction was impracticable, you need to disclose the circumstances that existed that made it impracticable. And you also need a description of how far were you able to go back. From when did you correct the error? The financial statements of your subsequent periods do not need to repeat the disclosure. An important concept we need to talk about is the term earliest period presented. IAS 8 regularly mentions the earliest period presented. If you go back to IAS 1, IAS 1 says you will always have in your financial statements your current year and your comparative year. But if one of the following happened, there's a retrospective change in an accounting policy or a retrospective restatement as a result of a prior period error, or there is a reclassification, you will have in your statement of financial position 3 columns. You will have your current year column, like we always do, and let's say that is for the reporting period ended 31 December 2019. You will show your comparative year, like we always do. That would be for the reporting period ended 31 December 2018. And then you will have a third column. That third column is not called the 2017 year. It is not for the reporting period ended 31 December 2017. That column, the third column, is titled Opening Balance of the Comparative Year. In other words, it would be a column with all the balances on 1 January 2018. This is really important because 2018 is still the earliest period presented. Nowhere does it say 2017. Your earliest period that you present in these financial statements is 2018. This is important for the requirements of IAS 8 that regularly refer to certain disclosure needs to be done for the earliest period presented. 2018 stays the earliest period presented. Your statement of financial position changes to include a third column. We have also already talked about the additional disclosure in the notes where there is a change in accounting policy or a correction of a prior period error. Another statement that looks a bit different is your statement of changes in equity. In your statement of changes in equity, you always start with opening balance of your prior year. And then you show the movements in equity of your prior year and then your current year. That opening balance in the statement of changes in equity, you need to now go and show what was the old opening balance, how much did it change with, and what is the new opening balance. So your first part of your statement of changes in equity will also look a bit different where there is a change in accounting policy or the correction of a prior period error.